Good afternoon and welcome to Scotia iTRADE's webinar. Today's topic is on implementing a trading strategy in a bearish market with the Montreal Exchange. But just before we get started, let's just do some quick house cleaning items. You should be able to hear me clearly now. If you're having any audio difficulties, just click on the sound check link in the audio panel on your GoToWebinar tool. And that should correct any issues that you may be experiencing. If you continue to have any audio difficulties, just you can either raise your hand or you may choose simply to click on the call in using your telephone. Just simply remember to use the access code and your audio pin ID as shown on the screen there. And just as a quick reminder, everyone will be muted for sound quality purposes. So here's a quick reminder for you, our disclaimer. Unless otherwise expressly stated by Scotia iTRADE, seminars, webinars, and other educational tools and resources, collectively content, are provided by independent third parties that are not affiliated with Scotia Capital Inc. or any of its affiliates. Scotia Capital Inc. and its affiliates neither endorse or approve nor are liable for any third-party content, third-party products or services, third-party content, or investment loss arising from any use of the content, including third-party content. This information that's being provided today will be for general information and educational purposes only. It's not intended to provide you any personal advice, any recommendations. So just keep that in mind as we go through the presentation. And as a quick reminder as well, options do involve risk. Options are not suitable for all investors. They are intended for sophisticated investors. So before trading options, please carefully review the options account agreement, which is contained in the Scotia iTRADE relationship disclosure document and the terms and conditions. I've provided a hyperlink on the screen here. However, you can simply go on to the scotiaitrade.com website under the forms page, and you'll be able to find this document there. Today, we will be using the GoToWebinar toolbar. The small orange icon that you see at the top there, the arrow, can be used to show or hide the control panel. Additionally, you can view this presentation in full screen mode. The hand icon that you see there can be used to indicate if there's any issues you may be receiving or if you have a question. Preferably, however, we'd like you to use the question panel box to type in your questions or your comments, and the presenter will be able to address them either directly during the presentation or at the end during the Q&A session. Today's session will be recorded as well, and an email will be sent to you tomorrow, say in mid-afternoon, with the link, a link to the recording. So you will be able to get that audio tomorrow in the mid-afternoon. You can also visit our YouTube channel. We have a list of webinars there in our on-demand playlist on our YouTube channel that you can actually go to if you would like to find other webinars that have been pre-recorded. And lastly, we are going to be downloading a PDF file for this presentation at the end of the session. So once we conclude, give it about 30 seconds or so, and I'll have uploaded for you the PDF deck that you can then use in addition with your audio link that you'll receive tomorrow to review and go over the presentation. So today we have with us then the Montreal Exchange. Jason Ayers is with us from the Montreal Exchange. And what they've done before is they've provided an options learning series. As you can see on the screen, we have a series 1, 2, 3, 4, and 5 that we've been kind of going through over the past little while. Today we're on series 5, part B, implementing a trading strategy in a bearish market. So as mentioned, if you'd like to see the other content in the series, just go to the YouTube page on the Webinars on Demand playlist, and you'll be able to get access to the other series in this presentation. Failing that, if you'd like to just email me, I can also send out links to those recordings. So as mentioned, today our presenter is Jason Ayres. He's with the Montreal Exchange. He's been an instructor with the Montreal Exchange for several years and actively advocates and educates investors on the practical utilization of options for managing risk, cash flow, and leverage. In addition to the development of numerous strategic relationships with some of the most prominent brokerages and exchanges in North America, Jason is the president of Learn to Trade Global, as well as founder of OptionSource.net. He is a derivative market specialist by designation. So at this point, I'm going to now move the presentation over to Jason, who will facilitate for the remainder. I'll follow up then with you at the end for a quick wrap-up and some next steps, and then I'll provide the presentation to you. So Jason, over to you.
All right, thanks very much, and good afternoon, everybody. We're just going to take a moment here and share the screen that is actually reflecting today's presentation, so just bear with me while I do that. So at this point, you should in fact be seeing the title slide for today's session, which is Option Strategies for a Bearish Market. Once again, my name is Jason Ayres, Derivative Market Specialist and Instructor for the Montreal Exchange. Just to echo Conlieff's sentiments regarding the disclaimer, just recognize that what we're covering here this afternoon is for educational purposes only, and you really do need to make sure that you truly understand the logistics of the options market before you actually move forward and try to implement these strategies within your live account. So with that in mind, what is it that we are looking to accomplish today? Well, we're going to focus on implementing strategies for a bearish market outlook, and we're going to start by looking at a put option and comparing that to the idea of short selling a stock. We're then going to evolve that position into a bear put debit spread. We'll also look at utilizing a bear call credit spread, and then wrap things up with a little bit of a general overview, and of course have some time for questions and such. So buying a put option. So why would we buy a put option? Well, the buyer of a put option believes that a stock is going to go down in value, so it becomes an alternative to short selling the underlying stock. Now, the opportunity that we have in utilizing a put option as a short stock replacement strategy is that we don't have to put up as much capital in order to create the position and take advantage of that directional bias. So it affords us what we would refer to as leverage. We could put up a small amount of capital to control a large amount of the underlying security. And when we do this, when we use the put option as a short stock replacement strategy, we limit our risk or our loss to the premium that we've paid. So I'm going to illustrate this in an example here in a few minutes, but recognize that we are able to once again take a bearish stance on a stock with a limited amount of capital and with a limited and identified risk. Now, the other consideration here, which I think is very important, is that if you're looking to take advantage of all types of market conditions and situations within your registered accounts, understand that really understand first of all that short selling in a registered account is not permissible, but purchasing a put option is. So within a registered account such as your RRSP or your TFSA, if you want to implement a bearish strategy, then you are permitted to purchase a put option as opposed to short selling the stock. So let's just take a look at an example that I pulled together this morning again, and I don't want anybody to think that this is a recommendation as we suggested at the beginning. This is just really for illustrative purposes only. So taking a look at a snapshot of CNR, Canadian National Railway, right now, and the idea is that perhaps we have an expectation that given the fact that the stock has made such a significant rally over the last year or so, and has perhaps maybe demonstrated a technical pattern indicating perhaps a reversal, we may want to take a bearish stance. So there's two ways that as an investor we might do so. One, for example, is we could be a short seller. So here we have John, and John is comfortable with short selling stocks. And again, recognize that John can only do this in a non-registered portfolio. So John, being bearish CNR, could short sell 1,000 shares of CNR, which currently is trading around the $101. But recognize that John is in fact shorting $101,000 worth of the stock. Now, of course, anybody that is familiar with margin within a portfolio that's non-registered will recognize that for this position, John probably only has to put up about 1/3 of the capital, but nonetheless, still responsible for the entire amount. So you could short sell the shares of the underlying security, and as the stock drops, the opportunity, the profit increases. Or you could take Jackie's approach here, which is to buy 10 September expiration 100 strike put options for $3.60 per share. So if we compare these two approaches here, you've got John who's short selling the stock that is essentially creating a $101,000 exposure, and you have Jackie here that's using a put option as a short stock replacement strategy that is controlling or benefiting from a drop in the CN shares below the $100 strike price, but instead of putting up the same amount of capital, is only putting up $3,600. Now, when we compare the two positions, once again, we've got John here on the left side shorting 1,000 shares at 101,000. Now, the important consideration here is that the risk associated with this position is essentially undefined. So the risk of the short seller is that if the shares increase in value, John is going to have to buy to cover, and the higher those shares go, the more risk and the more potential loss John is incurring. Okay. Now, if the shares in fact drop in value, the opportunity for the short seller is that if the short seller sold at $101 per share and was able to in fact buy to cover at 94, essentially the short seller has collected $101,000 and is essentially giving back $94,000, and as a result keeping the difference. So in this case, the short seller would benefit by about $7 per share, or $7,000, but would have an undefined risk. Okay. Now on the other side of it, with Jackie utilizing puts as a short stock replacement strategy, okay, she's paying out $3.60 per share, or exposed to about $3,600 worth of risk. So her risk, essentially, no matter how wrong she is, how high these shares go against her, she cannot lose any more than the premium that she's paid out, which is $3.60 per share, or $3,600. Now, if the shares drop to $94 as anticipated, well, she's going to make the profit of the difference between the settlement value at 94 and the strike price, which is 100, less the premium. So the difference, of course, between the strike price of $100 and the settlement value on expiration at 94 is $6. So the minimum value that that option contract is going to be worth is $6 per contract. It's the difference between the strike price and the, again, settlement value of the underlying security. But Jackie paid $3.60 per share. That at the time was all-time value. And so what happens is, on expiration, if the position was held until expiration, that $3.60 would have disappeared, leaving only what we would refer to leaving only the intrinsic value of the option contract, which is the $6. So the profit would ultimately be $2.40, or $2,400. Now, at first glance, one would step back and say, well, I would have generated a higher return had I short sold the securities. What you have to recognize is the short seller needs to have enough capital within their account in order to maintain that position. The short seller also has an unlimited and unidentifiable risk exposure. So while the rate of return on that move seems to be more impressive, we need to also consider the risk-adjusted return. So Jackie being able to limit the amount of capital that she's allocating and also defining her risk, in fact, has a better risk-adjusted return for the position. Now, don't get me wrong, there are times when short selling the underlying security may make sense, but understanding the flexibility of utilizing the put options is very important, because once again, that position could be implemented within a TFSA, that position could be implemented within an RSP, or that position could be implemented in an account that ultimately is relatively small comparative to what it would require to create a comparable position utilizing the underlying stock. Okay, so when we look at this comparison, what we need to understand is that as soon as Jackie implemented this this put strategy, she knew what the maximum risk was. Okay, we don't have that opportunity if we are just utilizing the underlying shares. Typically, under those circumstances, the risk is undefined and unlimited, technically. The other thing is that Jackie outlaid less capital, but controlled the same amount of short stock as John. But the trade-off is that Jackie has a limited time to be right. So very, very important consideration if you're looking at utilizing the put as a bearish strategy to replace a short stock position is that there is a time frame. And so that stock has to make the anticipated move within that time frame, or else that option expires worthless and it becomes a 100% loss to the investor. Now, understand as well that if the move happens relatively quickly, the position can be closed out at any time as well. So let's say rather than having to wait until expiration when all of the time component of the option contract has disappeared, if the move happens within a relatively short period of time, then Jackie would be able to benefit from the move in the stock in the direction she anticipated, plus be able to recover a percentage of the time value or time premium associated with the position as well. So that can happen at any time to lock in profits, or if Jackie feels that she's maybe made the wrong decision and that the shares are no longer looking bearish, she can also close out the position before expiration to mitigate the amount of risk or loss to the position. So for example, rather than losing $3.60 because the shares have gone in the opposite direction and she's held till expiration, she may consider looking at recovering 50% of her premium and closing the position out before that expiration date draws near. Right? Or the other consideration that Jackie has, if this is a non-registered account, is that she could exercise her right and take the short position in the underlying shares at 100 if she wants to maintain that position for an extended period of time. So really the benefit of utilizing the put option as a bearish stock replacement strategy is just the amount of flexibility associated with managing the trade. Limited risk, limited capital outlay, but you still have the choice to exercise your right to short sell if indeed you feel that makes the most sense for the trade that you're managing. Now, one of the challenges quite often in a bearish market environment, or when utilizing options on higher price stocks, is the fact that the option premiums can be somewhat expensive. So the opportunity that we have with a little understanding is that we can create combination strategies such as debit spreads in order to offset some of the costs. So a solution for reducing our cost and subsequent risk exposure on this CNR fictitious example here is to create what's known as a bear put debit spread. So really, as I mentioned, our objective when utilizing this bear put debit spread is that we want to reduce the cost of the trade and we want to reduce the break-even point as well as offset implied volatility. So just a reminder that if you need a refresher on implied volatility, those videos are available in the archive. But understand that when a stock starts to sell, or when a market in general becomes overall bearish, option premiums increase in value as a reflection of the risk associated with the security or with the market. So that's what we refer to as the implied volatility associated with the contract. So what we can do, if we are looking at a stock that's maybe already started to sell off and we're considering that the option contracts may be a little expensive because of the implied volatility factor, we could utilize a bear put debit spread. So I say that the outlook is moderately bearish because we actually are going to create a position that has limited profit potential. So we really feel that within a certain period of time that the stock is not going to drop as significantly or indefinitely as maybe if we were just buying the put option on its own. So the strategy calls for us to buy, or requires us to buy, one put option at the strike price that we want to establish our short position, and then subsequently find a lower strike price that is some distance away from the initial position, and we sell that, and that creates a credit. So the first position is we buy the put option and our account is debited, and then we follow up and we sell a strike price lower, and then our account is credited. Now, in this example, we're going to utilize the same expiration date, but keep in mind, the great thing about the options market is it's really as limited as your imagination. So you can utilize different expiration dates as well as different strike prices to construct these strategies. But for now, we're going to keep it simple. We're just going to do a typical bear put debit spread to demonstrate this. So let's take a look at the chart again. Again, we're sort of zooming in here, and we can see that shares are trading in and around that $101 level. We believe that the stock is going to drop in value, and so we're going to initially purchase the 100 strike put option at $3.60. So if I stopped there, that is essentially the first position, the first strategy that we just discussed, that idea that we're going to buy a put option, right? What we're going to do is we're going to add another layer of complexity here. We're going to turn around, we're going to go down to the 96 strike put option, and that's trading at $2.20. So we're going to buy the 100 strike put. It's going to cost us $3.60. Then we're going to turn around and we're going to sell the 96 strike put, and we're going to collect $2.20. So the net cost basis for this trade is $1.40. Now, recognize that the reason why it's referred to as a debit spread is that we are still paying out some money from our account in order to establish the position. So this $1.40 is considered a debit, and the difference between the strike prices is considered the spread. All right? So if we're looking to sort of understand the logistics here a little bit more, in order for us to determine what the maximum profit is, we take the spread between the strike prices, which is $4, and we subtract the debit that we've incurred. And in this case, you can see that the cost or the debit to our account is $1.40. We have the opportunity to make $2.60, provided that the underlying shares are trading below the written strike at or below the written strike price of $96 on expiration. Now, this trade has a break-even point. It's the purchase strike price minus the debit. So we bought the 100 strike put. We have a debit of $1.40. That means that our break-even point is $98.60. Now, just as a point of reference, if we compare the break-even point for the put option recognize that our break-even point for the put option alone is actually down at $96.40 because the break-even point of the put is established by taking the strike price and subtracting the net cost of the put option. So the original trade, the put was costing us $3.60. So by creating the debit spread, we've in fact lowered the amount by which the stock has to drop in order for us to break even. So we've essentially created a higher probability of us at the very least breaking even if the stock drops in our favor, because we've lowered the amount that it has to drop in order for us to reach that break-even point. Now, also recognize that the maximum loss to the position is the net debit. In this case, it's $1.40. So rather than having a maximum loss of $3.60, as our first example would suggest, we actually have reduced that down to $1.40. Now, important consideration here is that we can't create these spread strategies in our registered accounts. So a lot of times people ask, well, when would I use one over the other? So what I always suggest is, if you feel that a stock is going to drop significantly and in a very short period of time, and if you're comfortable with the implied volatility, then the put option is probably your best bet because you're not limiting your downside profit potential, and you're not adding that additional layer of complexity to managing the position. However, and if you're in a registered account, a TFSA or an RSP, the put option is your only solution as an option strategy to create that bearish exposure. But if all things considered, the premiums are expensive, implied volatility is high, the overall cost is a little bit too much considering the size of your account, and you really think that the move may be limited over a shorter period of time, then the bear put debit spread becomes a real interesting consideration in order to facilitate that trade and gain that exposure, but to do so again at a reduced cost and reduced break-even point. So just to sort of review all of the components of this strategy once again, remember that with the bear put spread, we're moderately bearish. So we are comfortable with only being able to profit from a fixed amount of the downside opportunity because our profit potential is limited to the spread differential. So in other words, doesn't matter how low the stock drops below our written strike price, we cannot generate any more profit beyond that particular point. The first step involves us purchasing a put option. That's considered a debit. We buy that contract and the money comes out of our account. The second step is that we're going to sell a strike price lower than the one that we've purchased, and we're going to collect a premium for that, and that premium comes into our account, and that ultimately creates the net debit and the cost of the position and the max cost of the position. So remember, the maximum profit is calculated by taking the spread differential between the two strike prices and subtracting the debit. Our break-even point is the purchase strike price minus the debit, and our max loss is the net debit. So we've got a limited risk exposure here, a lower break-even point, a lower cost basis to participate in a stock that we think is going to drop in value. Okay. Now, just a reminder again about the benefits of utilizing the debit spread. I think one of the most important considerations is the reduction in the cost of implied volatility. Implied volatility, if you haven't already taken the time to educate yourself on, is a very important consideration when you're looking at option strategy selection. So I feel that the debit spread becomes a fantastic tool for reducing that implied volatility variable. Now, of course, in general, under current market conditions, implied volatility really hasn't been all of that significant of a consideration, but it is very important to keep an eye on that as it is a significant variable within the options pricing model. You can also, in fact, mitigate the impact of time. So I want you to recognize that when we buy an option, we are suffering time depreciation from the point at which we purchase it. That's referred to as theta. Again, you can review this in our Introduction to Option Greeks video. But what happens is when we are the buyer of an option, we are suffering time depreciation. When we are the seller of an option contract, we're in fact benefiting from time depreciation. So when we implement the debit spread, we are in fact mitigating the net theta of the position, or we are lowering the rate of time depreciation associated with the position. So got a little bit more time to be patient for the move to take place. Now, that being said, we need to manage our pardon me, our performance expectations, because what happens is that when we create these spread strategies, there is a we offset the option Greeks, which are all of the mathematic calculations that determine the profitability and the how much a position will increase in value from a profit standpoint, and that sort of thing. So what happens is, let's say, for example, we create the spread strategy. Well, if the stock makes a significant move in a really short period of time, we may find that we're not profiting all that much comparative to if we had just bought the put option. So very important to make sure we understand the dynamics of the position and we manage our expectations accordingly. The other consideration is we lose the profit beyond the written strike. So in other words, as I mentioned earlier on, if the shares keep going, they drop below 96, they drop below 94, they drop below 90, we have the right. So think about the logistics of this position when we go back to Options 101. When we buy a put, we have the right to sell the shares at the strike price we purchased, so in this case the $100. When we sell a put, we have an obligation to buy the shares at that particular strike price, which means that we are limiting our profit potential to the difference between the strike price of the put that we purchased, where we have the right, and the strike price of the put option that we sold, where we've taken on an obligation. So we just get to keep the difference in that, and we need to be comfortable with that before we put the trade on, so that there's, we're not suffering from regret, in the midst of the trade, sitting back and saying, well, I wish I just bought a put option. Hindsight's 20/20. We got to make sure that we are choosing the taking our time and making sure that our strategy selection is well thought out, so that we're not suffering from that buyer's remorse, so to speak, once the trade is underway. Now, the other way that we can participate in a bearish market environment, I'll call it bearish to neutral, is by implementing what's referred to as a bear call credit spread. Now, this strategy is quite often considered to be an income strategy as well, because we are creating a net credit to our account. This is another one that is not permissible within your registered accounts, but is in fact a valuable strategy to understand in non-registered accounts for application in bearish or neutral market environments. So for the bear call credit spread, what we're going to do first of all is we're going to identify a level in the underlying shares where we don't believe that the share price is going to increase above within a certain time frame, because based on that expectation, we would then assume that the call options above that level are all likely to expire worthless, right? So remember, as the option writer, when you're using options to generate a credit, your expectation is that time is going to pass and the stock is going to stay the same or perhaps drop in value, and the option position or the option contract is going to lose value. So with the bear call credit spread, you want to sell that call at a point at which you believe the shares are going to remain below, and then subsequently take advantage of time depreciation as well as the the drop in the share value. So the follow-up to that, in order to create the spread and to manage the risk exposure, is we're going to then purchase a call option above the sold strike to limit the potential loss. What happens is the cost of that call option that is positioned above the sold strike is subtracted from the credit that we've received. If the underlying is at or below the written strike price, we keep the credit. So if we take a look at this example utilizing CNR again, and let's say we take a look at, again, with it trading around the $101, we have an expectation that the stock is likely going to drop below that. So what we want to do is we want to look at the call option. Now this kind of seems counterintuitive, I know, because we always think, a call option we associate with a bullish market, right? But remember, it all depends on what side of the trade you're on. And so in this case, we're not buying the call, we're selling the call. And when we sell the call, remember, we're collecting a credit, and we expect that if the shares drop in value, that the premium that we've collected here, which in this case is $4.30, is going to continue to erode to the point where we collect the full profit. So if the shares are trading anywhere below $100 on expiration, we keep the entire premium. Our risk is that when we sell the call option, remember, as an option seller or option writer, as we'll refer to it, you have an obligation. And that obligation is that in the case of the call option, you will deliver the shares at the strike price written. So that's all well and good if you already own the underlying shares, because it's just, you own the shares, you're just simply using those shares to offset that obligation. But if you don't own the shares, you got to go buy them. And the challenge is, if you sold the call at 100 and you took on the obligation to deliver the shares at 100, because that's what you're getting paid for, if the shares all of a sudden skyrocket to 110, well, guess what? You got to go out into the markets, you got to buy those shares at 110, and you have to deliver them at 100. So your loss on that position would be the $10 difference between the strike price that you obligated to deliver the shares at and wherever you had to go out into the market and buy them at, right? Less, of course, the premium that you've collected. So in order to reduce that risk exposure and also reduce our margin requirements, so I want you to recognize as well, if we sell that call without without the underlying shares, or without some sort of what I'll call a protective leg to the strategy, then the broker is going to say, okay, well, you have to put up enough capital to buy the shares at 100, at 101, okay, now it's at 105, you need to have enough margin to buy the shares at 105, and so on and so forth. So you are all of a sudden in a position where you are at risk of a margin call, you have a margin exposure, and a requirement there to make sure that it's maintained. Whereas, in order to limit that and identify that requirement, what we can do is we can turn around as part of the strategy and buy the call option at a higher strike. So again, if we think this through a little bit based on sort of options 101, we sell the call, we have an obligation to deliver at 100, but when we buy the call, we have the right to buy, in this example, at 105. So it doesn't matter how much higher the shares trade above the 105 call that we own, we are limited to the difference between the 100 and 105 strike. So in other words, we have the obligation to deliver at 100, but we have the right to buy at 105. Therefore, our maximum risk exposure is the $5 difference minus the credit that we've received on the transaction. All right. So if we look at again in this example here, we sell the 100 strike call and we collect $4.30. We buy the 105 strike call. We pay out $1.95 of that credit. We're left with a net credit of $2.35. And so our risk exposure is the $5 spread differential between the strike prices less the credit that we've received. So important to understand that the maximum profit for this trade is the net credit of $2.35. So again, no matter how low the stock drops below 100, we can't make any more than the credit that we've received. But that may be okay. It looks like a reasonable risk-reward proposition, and this is a very passive strategy in that as long as the shares are trading below the strike price that you've purchased, you really don't have to do anything. All the options will expire worthless on expiration, and you get to keep the premium. So again, maximum profit is the net credit of $2.35. Maximum risk is the difference between the $100 strike and the 105 strike prices less the credit. So your maximum risk on this trade would be $2.65. Our break-even point on this is the written strike price plus the credit. So in other words, as the shares trade above 100, we basically have to, if we need to close the position, we're now starting to give back, or required to give back, a portion of our premium, right? So in other words, as long as the shares stay below, in this case it would be the 102.35, which is the credit that we've received, then we are essentially at a small profit or break even. But as soon as the stock starts to go above that 102.35, that's when we have to start giving some of our own money back to essentially cover the risk or the loss. Now, that said, we can close the position out any time. So if we feel that it's going against us, no different than we were looking at the debit spread or the put itself, we can close it out at any time and limit the amount of risk that we're incurring, but understanding that the maximum risk, once again, is the difference between the spread minus the credit. And our break-even point is the written call strike plus the premium. Okay, so again, just to quickly review the logistics of the bear call spread, we're looking at this as a bearish to neutral strategy, and the reason why I integrate the neutral sort of bias is because really, as long as the stock stays the same or trades within a range, we can still profit fully from this position. So, you know, for stocks where you basically believe they're going to consolidate within a certain price range over a period of time, this bear call spread becomes a really interesting consideration. First step is we're going to sell the call and collect the credit. Second step is we're going to use some of that credit to buy a call option at a cheaper, at a higher strike price, and of course, the further out of the money that option contract is that we have to buy, the cheaper it is. So the less of the credit we have to put up for that. Once again, the maximum profit is the net credit that we are receiving. Maximum risk is the difference between the strike price less the credit, and our break even is the written strike price plus the credit. Okay, so which strategy? Again, very important consideration. It really comes down to what it is that you are trying to accomplish. So if you're looking at trading a directional bias and you feel that the underlying stock is likely going to make a significant move in a very short period of time, and quite often the put option, provided that implied volatility is reasonable, is your best solution. Easiest to manage, essentially one transaction, and you can get in and out of that, relatively efficiently. If you, again, if all things considered, implied volatility is high or the option premiums are expensive because the stock's expensive, you could evolve that into a bear put spread and take advantage of a move within a particular range, again offsetting the cost of the position, lowering the break-even point, reducing the impact of implied volatility, and that's always worth considering, I believe, before you move forward. If you're satisfied with or if you believe that the opportunity is more of a chance to generate some cash flow or some income, and you are more of a passive investor, then your credit spread becomes an interesting consideration. Now, one thing that you want to recognize is the further out of the money you've established that spread. So in other words, if we go back to the CNR example, if the shares are trading at 101, rather than writing the 100 or selling the 100 strike call, what we could do is we could go up to the 105. We're going to collect less premium, but we have a higher probability of generating the full income of the credit spread because we're further out of the money. So it's important to just understand what it is that you're trying to accomplish. weigh out the risk versus reward and be comfortable with it, and also be comfortable with how what your skill level is at managing these positions as well. The other, of course, as I mentioned, is registered versus non-registered. Within our registered accounts, all we can really do, as in considering the examples that we use here today, is simply buy a put option. Right? Still great opportunity, lots of opportunity there to integrate that strategy, and lots of flexibility in as to how you position yourself, strike price selection, expiration date, that sort of thing. But we are limited within the registered account versus non-registered, where we can do any number of strategies and combinations to trade our investment outlook. And the other, finally, is it share ownership versus stock replacement? If you have the intention of taking on a short position, and you just want to use the put option as a way of entering into that, then that's your consideration there. There's some other ways that you can actually position yourself utilizing, let's say, you could short the stock and buy a call option, and that becomes a little bit more of a sophisticated strategy. Didn't share that with you guys here today, but you could short the stock and buy a call option, and that becomes a protected position. It's kind of the inverse to buy the stock and purchase a protective put. Right, so if you want share ownership, you could build a strategy around that versus looking to completely replace the position utilizing options. Right. So before we jump in and take any questions, just a couple of considerations here. We want to make sure everybody understands the resources that are available at the Montreal Exchange site. Of course, we've got blogs at optionmatters.ca. Lots of great contributors there that I encourage you to join in and take some time to get to know. There's investors options trading letters, videos and webinars, trading guides and strategies, option calculators, covered call calculators, options trading simulator, and just recently introduced, which I think is a really neat little tool, is what's referred to as options play. So you guys can go check this out, and it's essentially a stock and options analysis suite that allows you to go in and input a stock symbol, and then it'll actually search the options world for different strategies to implement around that particular stock, based on option premiums and implied volatility, so ideas for directional trades, ideas for income generating, etc. So again, something that you guys can check out on the Montreal Exchange site that's may be helpful in you sort of understanding where and how to find different strategies to apply. And then what I would recommend, just to follow through with this, is take some time in the options trading simulator to execute those strategies. So that's a great sort of complementary combination there for those of you that are just trying to get to understand the logistics of the option market, to go in, find some ideas, find some opportunities, execute them in the options trading simulator, and see how you do managing the trades before you actually go in and do so in your live trading environment. So on that note, guys, I'll pass it back over to Conley F, and I don't see any questions in the based on the mode that I'm in here. So Conley F, I'm not sure if you've received any, but I'll trust that you'll read them off, and I can answer accordingly.
Thank you, Jason. I really appreciate that. I think there was one hand raised, and let's just see. Elijah, I believe that was your hand raised. If you have a question, if you could just type it into the question box, that would be great. And if anyone else has any other questions, please feel free to type those into the question box, and Jason can address them. Okay. So while we're waiting for any other questions, oh, there we go. Here's a question from Elijah. What is the difference between registered and non-registered accounts?
Well, I mean, I can field this, Conley, if you want. I mean, a registered account would be referencing your RRSP and your TFSA, your RESP, your LIF, LIR, etc. And there are rules associated with the utilization of margin. In fact, you can't trade on margin. You can't leverage those portfolios. So for some reason, the utilization of spread strategies, such as the ones we referenced here, is not permissible, right? So it's an unfortunate fact of the matter. So we're limited to what we can do in our RRSPs and our TFSAs, for example. But non-registered would be, your non-registered margin account that it's not tax sheltered, that you can do some of these other strategies, these combinations. Hopefully that clarifies it a little bit for you there.
Right. Thank you, Jason. And just maybe just to build on that really quickly, Scotia iTRADE offers the cash account and the margin account. As Jason mentioned, with the margin account, you can leverage if you've been approved for a margin account. For the cash account, of course, you're paying for it cash up front. Scotia iTRADE doesn't allow option trading in cash accounts, so you would be limited to the margin account if you're looking for options trading. For registered accounts, as mentioned, we only do the two strategies, the buying puts and calls, and covered call writing. So you can buy puts, you can buy calls, and you can do covered call writings. In registered accounts, those are the only strategies that Scotia iTRADE would allow. So for spreads, you would be doing that in your margin account, and any other shorting positions on that. We hope that clarifies the question, Elijah. Great. So we don't see any other questions at this point, so I'm going to now go ahead with the closing comments. If there are any other questions, please take this opportunity to type them in, and we'll be able to address those. And you can always, excuse me here, you can always email me at education@scotiaitrade.com, and I can address those questions with Jason, or I can address them directly with yourself as well. So what's next? You can, as I mentioned, access the webinar recordings on our YouTube channel. www.scotiaitrade.com is our website. At the bottom of the page, you can see our YouTube link. Click on that and go over to the playlist, Webinars on Demand, and you'll find there a list of our webinars that we've got archived for you. If you do not see what you're looking for, just email me at the education@scotiaitrade.com, and I'll send it out to you. Now, today, when you exit the webinar session, we will be uploading a short survey for you. We just ask that you complete that so that we can let us know if the information that we're providing for you is relevant and to your needs. And if you've got any other additional suggestions for what you want to see, hear, learn, please include it there as well, too. Going forward, I'd like you to mark your calendars. We have two webinars that I'd like to mention briefly here. On June the 7th, Wednesday, June 7th at 1 p.m., Pro Market Advisors will be providing a session on call options, getting started with call options. So this will be the introductory piece to the call options, defining some of the terms, terminologies that is used, and some of the strategies that one can use with call options. And then on June 8th, following day, Thursday, June 8th at 1 p.m., the market guys will be speaking to us on managing risk in volatile markets. So both those are on the event or under education page under the events calendar. Just click on that. You'll see a list of all the webinars there. You can just upload those or register for those and join the session going forward. So at this point, on behalf of Scotia iTRADE and the Client Education Department here, I'd like to thank Jason Ayers from the Montreal Exchange for a wonderful presentation, very informative. And I'd also like to thank each one of you who have joined us today. We welcome you to register for additional webinars going forward, and we hope to see you again. So thank you. I'm going to now take an opportunity to upload the deck for today that you then will be able to download. So bear with me one moment while I do this.
All right. Well, thanks very much, everybody. Always a pleasure to work with Scotia iTRADE, and look forward to our next presentation.
Great. Thank you very much, Jason. We're also looking forward as well. Take care.
All right, bye for now.
Bye-bye. Okay, so our webinar is the deck, sorry, is being uploaded right now. It's completed for you, so you can now download that deck into your own computer and save it. Tomorrow at mid-afternoon, 1:30ish too, you'll receive an automated link with the recording that you can be able to watch and listen while going through the deck as well too. So once again, thank you very much for your time today, and have a beautiful rest of the afternoon. Take care.